Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce and Associates Wealth Consulting, and welcome to Charts and Chat for August 2nd of 2026. It's good to be with you after a couple weeks break for summer vacation. We've had some data during the interim, so let's get into it now. First, the Fed met last week and kept rates on hold. You can see here that basically for the balance of this current year, we've been fairly flattish. The sentiment has obviously changed. We've talked about that a lot. Beginning of the year, we thought we might be getting a couple of rate cuts. Inflation has proven sticky, and obviously we've got energy-borne and commodity-borne inflation from the Iran conflict that's causing inflation overall to be sticky, although some components do seem to be falling. We'll take a look at that in a second. But needless to say, there's not a real strong conviction on the part of the overall Fed right now. But it's important to note in these black columns here that over the last several Fed meetings that we've seen some dissents. And most recently, we've seen dissents erring on the side of wanting to tighten credit or actually raise the short-term interest rates. And so, again, Kevin Warsh is brand new at the Fed. He's in his first couple of meetings here, and he's trying to establish a cadence. Every Fed president, comes in and brings their own personality, brings their own cadence, brings their own vibe, if you will. And so, we know that Kevin Warsh is going to be a lot different from Jerome Powell. And, there's some things that he wants to do to kind of reform the Fed. One of them is, maybe go to a less frequent policy evaluation regime, where instead of meeting every 6 weeks, they maybe meet every 2 to 3 months or something like that. And we'll see this all play out over a period of time. But right now, and we'll talk about this too, the bond market Kevin Warsh is letting the bond market price in its appropriate level of risk. And we've talked a lot about how the bond market does a really good job, more so than the equity markets, of foreshadowing where they feel like the economy is going to go. And, in the past, we've had a lot of transmission, a lot of sentiment that's been transmitted from the Fed statements into the bond market. And it does appear that Kevin Warsh is not going to be doing that as much, leaving the bond market to its own devices. And as a result, we've seen, and we'll see this in a second, interest rates are moving higher at the longer end of the curve. One area that we haven't really spoken about recently has been tariffs. And, again, a big topic last year, obviously. This year, we've seen some court-related actions striking down some of the tariffs that the Trump regime has wanted to implement. Just this past week, we've got announcements of new 10 to 15% tariffs that are meant to replace those that have been struck down. But clearly, when you talk about sticky inflation, a lot of these tariffs have already been anniversaried, but you can see the overall level after having witnessed some of those tariffs be struck down. That tariff level is now in kind of a 6 to 7% range. Now we'll talk about inflation. We've got the PCE price index. This is the Fed's preferred measure of inflation. You can see here the headline number was actually down ever so slightly on the last reading. It was expected to be down a little bit. Again, not taking too much, placing too much emphasis on the 1 month number, because food and particularly energy right now has been extremely volatile with all the Iranian conflict pronouncements here. And you get down to the core, which strips out food and energy. You can see that it was positive, a little bit lower than expected, and certainly lower than we've seen it in prior months. Maybe a little bit of a positive takeaway there. As we go over here and look at the annualized numbers, you can see here the 1 month 0.13 translates into 1.6% annualized number. But if you go out a little bit farther on the curve here, like 6 months and year over year, that number is looking anywhere between 3 and 4%. And you can see, if anything, that's just kind of sticky right here. So again, discounting the weight of 1 month numbers, you can see the trend line is that we have had a little bit of a pickup inflation here this year. Nothing that gets us back to where we were several years ago, but nevertheless a point of issue with the Fed, as we just discussed in their latest meeting. They kept rates on hold, but they're paying close attention to this as a potential lever to perhaps raising rates a little bit later this year, or perhaps a very early part of 2027. Now we've got 4 different areas of the PCE calculation that we want to touch base on here. We've got the cyclical services, again, showing a little bit of inflation here, as we do see in the less cyclical areas. Not a whole lot of acceleration here, like maybe a little bit we see right here. This is about 5%. This is obviously less than that. So this is the area right here that we want to maintain our firm focus on. Here we have housing, which had been coming down for quite some time. We see a little bit of an uptick and maybe an inflection point rolling back over again. Again, not quite sure. We see that one falling in around 3.5%. And then goods inflation, which is really over the last year is what we've been talking about. We've seen, kind of a reacceleration of inflation there, but just recently a downtick in that. So as I mentioned, the Fed's in a very interesting place, right? In a different place than they were at the beginning of the year, because now there's a bias towards raising rates to fight this persnickety inflation. And again, the bond market is being asked to provide its own assessment of risk in the market. And so there's a lot of things going on here. There's the hyperscaler issuance. There's the fear that the AI story may not hold. You've got kind of basically a fiscal deficit, which seems to be very persistent, and our national debt is increasing. So the burdens on the U.S. taxpayer looking out 10 to 20 years is something that's really beginning to get the attention of the bond market. And you can see why that we have in our long bond rates, we're now above 5%. We have not seen that since 2007. This is actually a big deal. And again, it maybe helps long-term savers, certainly hurts borrowers. And when you think about the impact downstream on the 10-year, it hurts mortgage, those who take out mortgages. And it has a lot of ramifications if the bond market is going to price in a risk, price in additional risk insofar as a term premium is concerned on these 30-year yields. Here we have the difference between the 2-year Treasury and the 30-year. You can see here that we had, basically a really flat curve back in 2024, and we had some steepening as we went along. You can see that that's, we had a little bit of a reversal here, but now the difference between those two is about 1 percentage point or 100 basis points. Now we look at the 30-year mortgage rate versus the 10-year bond yield. As we know, those 30-year rates are indexed to a degree on that 10-year. And so you can see the mortgage rates here in the black line, about 6.5%, 6.6%. I do think with rates moving higher that they're probably going to hit 7 before too long. Here we've got the 10-year bond yield around 4.7. Again, we already know that the 30-year is above 5%. You can see the difference between those two is about a little bit less than 200 basis points or 2 percentage points. You can see the effect on the mortgage market. As I said, we've got rates that are moving higher, and they're not too far off 7%. You can see the average rate of mortgages outstanding just continues to move higher and higher as we move along. Home prices, something else that's weighing on affordability here is that median prices have hit a new record. And again, this is something with inflation that you honestly expect to see over time. And I'm not going to tell you that we maybe have had an acceleration, although 2021, 22 represent certainly a clear deviation from the prior trend line. So, that trend line is looking like about here, and then we're clearly above that. But the rate of that growth is moderated back to perhaps closer to a point where we would have expected. But needless to say, those home prices are high, and again, the median price just means that that half of all price observations are above that and half are below it. But again, when you got higher mortgage rates and you have higher home prices, that really puts a pinch on affordability. And as we know, that's driving less new home ownership, or at least it's delaying new home ownership by the younger rising generation. And there's a lot of other impacts to that as well. Here we have national debt. So just a quick minute on this, because again, this is something that is influencing our long-term bond market right now and our yield curve. And so we've got 40 trillion of national debt here. And again, if you say you're going to price a lot of, now granted, a lot of this new debt that's coming on is priced at shorter rates. And so we're issuing more kind of like sub 10-year debt, which I'm not sure that I would necessarily agree with, because you're going to have to pay the piper at some point down the road. But needless to say, we've got 1 trillion of interest that we're paying right now on our national debt. But when you get down to, like in the next 8 to 10 years, that's going to look more like 2 trillion. And then even the Congressional Budget Office has increased their outlook of debt based on our ongoing deficits. Like back in March of last year, we were looking at about 156% of GDP, and now that's looking like 175. We're going to be talking a lot about this over the coming years. It's not really playing itself out in call it the equity markets. But as I mentioned, the bond market is usually a lot better and a lot faster to kind of sniff these things out. And this is why you're seeing, one of the reasons why you're seeing higher long-term rates. So let's take a different look at this. We talked about like how the picture is going to change over the next 10 years. And this is a good slide for that from the Congressional Budget Office, their own projections. And you can see that they break it down into two sections. So here's 2026, that basically the federal deficit as a percent of GDP is just under 6%. And that's broken out by interest expense and the deficit, the primary deficit, which accounts for all other spending here. And so the primary deficit actually over the next 10 years is expected to fall. That's not to say that that we're going to be fiscally necessarily fiscally sound, because this does not imply a balanced budget by any stretch. And because of that, we're going to have to cover our nut somehow. If you spend more than you receive, obviously that's going to require more borrowing. And so as you do that, coupled with the fact that you're likely to have an average interest rate on that debt service that's higher than it is today, perhaps, then you're driving net interest on the debt from 3.3 to 4.6. So this is what we're going to be talking about, moving from 6 to close to 7% of GDP over the coming years. How are we going to tackle this, and how are we going to address this as we get into the next generation and even the generation after that, that's going to have to shoulder this increased burden? Well, another key data point that we received since the last time we got together was the second quarter GDP numbers. And the estimate was for about 2.1%. It came in at 1.5. So a little bit of a disappointment there. We can see the various components here as they track over time. I always love this chart from the Daily Shot, because it really highlights that there are always kind of like different levers from one quarter to the next. And this particular quarter, we had inventory drawdown. That's the red here. We had a little bit of net drag from government spending, and you can see that that these things sometimes offset offset themselves from one quarter to the next. Benefit from personal consumption, that was pretty strong, and business investment was also strong. And you can see in this slide over here, if you look at the second quarter here in this amber color, you can see the inventory drag, net trade here was a negative impact, as well as government spending. And again, as we've seen here over both the single point as well as the trailing averages, that residential investment's really been kind of a net neutral thing. Business investment, we had stronger capital spending, and then here personal consumption, they're calling it like the World Cup effect. I think that has something to do with it, but again, the contribution from personal consumption over the 10 years, you can see, has been about 2%. So it's fairly consistent. So this is something that we would have otherwise expected anyway. So now we see this in a little bit different lens here. You can see, again, this is just a one period. It kind of cleans it up and gives you these little slide bars here that just kind of makes it a little easier to read. But again, non-resi investment positive, consumer spending was positive, both on goods and services, and then federal government was a drag, as was a change in inventories, and we know that net trade continues to be a bit of a drag. So now a chart here that kind of plots real GDP, which again, as we saw, was 1.5%. That's in the blue line here. Again, that's the first reading on this. So we'll get two more readings before that number is finalized. You get one in August coming up, the fourth week of this month, and you get one in September. And then they'll close the books on the second quarter, and then we'll have the third quarter reading. I show this chart too, not because we've already seen that the real GDP for the second quarter was 1.5%, but I also want to show you real final sales to private domestic purchasers. So this is a primary input, and that remains really strong. And again, this data can be a little noisy at times. There's generally a positive correlation. Not this time. These things have diverged, and we'll kind of delve into that here in just a second. So we see here that demand remains really, really high for computer electronics. That's probably no surprise. We talk about AI a lot, and we're not necessarily talking about your laptop Dell computers, but you're talking about a lot of other things tied into computer and electronics that feed into AI, that feed into data centers, and feed into this whole capital spending story that we've been talking about. And you can see that this is actually kind of a parabolic expansion, and you can see that this dates back to about 2016 when we saw this reemergence, but the acceleration here is kind of predicated on AI. Here we've got the Atlanta Fed. You can see here in this amber line, we've got the second quarter of 2026. We got 1.5%. This is where they have places. You can see that the original estimate was something closer to 4%. So you can kind of view the transition like basically over what we'll call like 2 months ago. The expectation was a lot higher than what we got, and we'll just have to see where the revisions go. But needless to say, overall economic growth not as strong as what we would have thought, even a few months ago, and particularly before the bombing campaign in Iran. Here we got personal income. That number was positive. It was maybe a little bit less than expected. You can see that we've had, by and large, some pretty good data going back to 2021. Over here, we've got real disposable income, which is inflation adjusted. You can see that that is just ever so slightly positive. Annualized, the monthly data annualized about 4%. So you can see that this has come down a little bit. Now we have real personal consumption expenditures, PCE, that was up 0.4%. You can see that broken down into basically goods and then services, both are tracking north. You can see the line of best fit right here going back several years. So, this is really is kind of steady a data as you can get in the economic world. Now we'll go into some more esoteric things related to consumption. First of all is the savings rate, and that continues to fall. So you do have declining rates of savings, although at 2.7% is actually positive. And so we just have a declining rate of that savings because we have more consumption. And then we also have a backstop, a cash pile, if you will. You can see in the K-shaped economy here that you've had degradation of that amongst the bottom 20%. But when you get into the top 1%, even 40, 60, 80, 90%, you still have some wherewithal left, some savings, even though that rate of growth on that savings is decelerating. So wealth accumulation as a percent of GDP, we've seen a tremendous amount of that. A lot of this has to do with home prices, also equity price appreciation, because we know that more homeowners and more consumers are owners of securities and stocks. But that wealth is being concentrated in the very top echelons. And you see, here is the wealth of the top, what is that, the 1/100,000th of Americans as a percent of national income, and that's 12%. And you can see, going back, let's call that 2010, so that's after the global financial crisis, that number was about 3%. So we've gone from 3 to 12% in basically, let's call it about 15 years. And again, as we talk about the haves and the have-nots, the haves are much more influential. And I think this has ramifications as you read consumption-related data, that you tend to get more of a skewing factor, that folks in this level they're perfectly happy about everything that's going on in the economy. They're not sensing, they don't care about beef prices being more expensive. They don't care about the price of eggs. Their consumption patterns are not predicated. There's a great degree of price elasticity amongst the top earners and the top wealth in America. And again, what it's going to do is it's going to drive a demand to become much more introspective on all of the data, and then parsing it out by cohort, because obviously we do have increased stress at the lower income levels. Corporate profits. This is another thing that really caught my attention here, and these things often move in opposite directions. But I guess what really caught my attention here was the gap. Again, you can see that these things tend to work in opposite quite a bit. But basically, what this chart is telling you is that employees as basically as an economic class here are not witnessing the same types of economic rewards as companies are. So the labor's share of profits, if you will, is been in net decline. And again, these types of things tend to work themselves out over time. And obviously, you see adjustments when labor is not getting what they call their fair share of the economic reward. Then you see compensation changes. You see a response to that, and I would certainly expect that here. Here we have a quick check-in on crude oil. This is something that I think, again, as we talk about heading into the fall, that if we don't have a firm resolution on this Iranian conflict, I think we're going to be spending more time talking on this, because as you see here, these are the crude oil stocks, again, below the 5-year average. Gasoline and distillate stocks are kind of either at the low end or below their range. If you include the Strategic Petroleum Reserve, the SPR, and you look at overall crude oil inventories, you can see that you've got to go back to 1984 to see them as low as they are now. And you can see that this is a pretty dramatic drop here. And so, when you get to a point where you don't have enough crude to maintain high throughput and high utilization in your refinery base, when you're cracking that crude into all of its derivative products, that creates an operational problem at the refining level, right? If you get down to, you go from 80, 90% utilization, which is kind of like a nominal utilization level at the refineries, to something that looks more like 75 or 72, even for a short period of time, that has major implications for, cost, profitability, et cetera. And obviously, if, those costs get passed downstream, and so, you wind up seeing higher gasoline and jet fuel, and heating oil and all of the derivative products will go up. Now we'll switch our attention here to the investment markets chart that I've shown you quite a bit over time. You can see the active managers index remains pretty high. It's kind of oscillated a little bit here. The 4-week moving average looks like maybe it's rolled over a little bit, but still anything between 80 and 90% is pretty high. If you go then and look at the individual investor sentiment, it actually remains relatively good, although we've seen some bloom off the rose here as the bearish sentiment has kind of picked up again. But again, one reading does not a trend make, because you can see that this number has bounced around quite a bit. So I would say, even though the preponderance of data has maybe been a little bit down, over the last several months, again, owing to things that are going on geopolitically in our world, perhaps. But it's not overly concerning. You don't see this massive, fear necessarily being priced in yet. However, I do say that that is going to beg me to keep my eyes wide open for inflection points with regard to sentiment. Now, as we talk about sentiment and risk and where does the market go and what should we, need to be thinking about right now here in late summer, this is one thing, and this is from Bloomberg, and this is basically a valuation composite level. So it reconciles both trailing PE, forward price to earnings, cyclically adjusted price to earnings, price to book, price to sales, enterprise value, EBITDA, Q ratio, and all these things. This is like a composite of all these different valuation metrics. And by that composite, we've reached a new high in terms of valuations. And notable prior peaks, 1929, of course, we all know what happened that year. 1965 was another kind of interesting year. It kind of presaged what we saw in, increased inflation in the 70s. 1999 presaged the tech bubble bursting, and this is basically the long-term logarithmic ascension of overall S&P prices. Now, all right, so this gets our attention. Now we look over at the bull and bear indicator, and we find ourselves in fairly bullish territory here. Again, you've got valuations that are high, but you have a lot of optimism in the market, and that kind of gets you to a point of kind of, running the risk of pricing for perfection. And if you have a disappointment, then, this kind of sentiment can unwind itself fairly quickly, and we want to be really prepared for inflection points, which might indicate that. Now we'll talk about IPOs, kind of bringing you up to speed. I did have a chart, I didn't include it in here, but SpaceX is down like 23% from its initial public offering price, and for all the hubbub that we had in SpaceX, this chart from Apollo really does a good job of highlighting the fact that since 2019, IPOs have really not done that well. Right? It may feel good, and everyone wants to own SpaceX because it's the neat new thing or whatever. But having said that, these IPOs have generally underperformed the market, and there are a lot of reasons for that. Obviously we've got higher interest rates, So hurdle rates on investment have gone up, and there's other things too that have played into this. But just everyone thinks of these IPOs as like the grass being greener on the other side, and it really isn't. And we've shown you in the past that average IPO drawdowns can be up to 50% at their maximum drawdown point. And again, not wanting to get too caught up in the euphoria of these things, but again, stay disciplined to your investment policy. Now we look at the S&P 500. Here is the forward earnings, and again, to the eyes wide open thing, and what's getting our attention. This is it. This is one of those things, I should say. We just showed you valuations are high, enthusiasm is high, earnings estimates are moving higher in almost a geometric way, upwards of 30% year over year. This is just levels that you just don't see very much. Consensus earnings growth, looking at over 12 months, is something obviously we just got through talking about. But if you look over long term, these estimates are looking pretty high, and so I just get a little cautious when I see data like this. Again, a lot of euphoria is being priced into it, and a lot of expectations are being padded. Now, having said that, if you had bet against earnings growth, meaning that like over the last 3 to 5 years, you have been a skeptic and said, no, the market is not going to have this level of earnings capability, and you bet against it, you would have been flat wrong with your head handed to you. But again, you look at the kind of the line of best fit, let's just take it like in a microcosm, like from 2010, it looks like this, and it puts us about 275-ish, something like that. And then, to see where we are now is a clear deviation from that. Now we look at, kind of the trend line. Now, I kind of showed you long-term projections, but this kind of breaks it down into quarters. And of course, we're in the second quarter right now. We have miscellaneous income that's added in here to these very large hyperscaler type folks that have a very strong influence on the overall S&P 500 because of their cap size. But, you can see that has a lot to do with this earnings growth rate, but you can see here that at least from a consensus standpoint that we're going to have a bit of deceleration in the coming quarters in 2027. Looks to be a bit more benign, if you will. If you look at kind of the overall rate, which is in these diamonds, then what that tells you is that we're going to get something that looks a little bit more steady over the next 6 quarters than what we've seen here in the second quarter. So suffice it to say, these earnings that we're getting over the coming weeks are going to, I think really set the stage for, how things play out. Third quarter numbers are going to be very important because there's a lot of optimism built into it. If they disappoint, then I think we could see a bit of a sell-off heading into the end of the year. And again, just too early to tell. Forward PE, we just got through talking about valuations. Here's the latest. Just looking at the index in its aggregate, down off its peaks, which is positive, but still above that one standard deviation, which means that basically 67% of all observations of price to earnings are going to be below this line, and so we're still in a little bit of rarefied air. But one thing I wanted to point out, and this will be evident in another slide I've got coming up, is that we've seen dispersion between some of these sectors, and even dispersion in earnings growth and volatility. And there's not a perfect uniformity of how this market is going, so not all boats are necessarily being lifted the same way. And you can see this is a sector forward PE, and you can see where valuations are most rich. You've got the consumer sectors here that are, again, I'd say consumer discretionary, almost priced to kind of a perfection. You've seen these ranges, and this diamond represents kind of where it sits right now. Energy kind of at the, we've seen all sorts of, gyrations in energy forward PE based on, geopolitical tensions. But you can see the distribution here amongst the various sectors. Retail trading is really strong. You've got a lot of activity in the market, some of it, related to the IPOs that we were just visiting about. Some of it, related to the fact that, there's been a commoditization of how small investors can get involved in the market, like can open a Robinhood account and so on and so forth. So retail volume really picking up, and that does help to drive potential volatility, which VIX is what we have here. And we could see a little bit of pickup in volatility. Again, something over 20 is enough to get your attention. It's not a huge spike by any stretch, and we've had pretty low stretches of volatility, over the last several years. And this uptick is partially a function of this, but it's also a function of kind of increased fear and maybe increased skepticism over the viability of this whole near-term AI model that hyperscaler spending is going to really manifest into returns on investment that exceed their cost of capital. And again, there's a lot of things we don't know yet, and as a result, we see volatility picking up a little bit here. This is a slide I was referring to before. This is where, there's a greater than 10 percentage point deviation in sectors. And so this tells you that you've got like increased or decreased market leadership. And so you've got sectors that are going in different directions necessarily, even though the overall index may be moving higher. It's just not a uniform move. Another interesting development that is worth noting here is that we've seen a lot of momentum selling. And again, that comes from that skepticism over, like I said, the viability of that whole AI business model. Are we getting out ahead of ourselves? Are we spending too much and we're not going to be able to recover all those investments in terms of our expected returns? And so as a result, we've seen selling and momentum, and that's given a little bit of a boost to value. And so you see that, we've had a changing of kind of market leadership from this hyper growth to value stocks. And yet another thing that I think is worth noting here is the impact of inflation volatility on stocks, and and how it translates into earnings expectations, et cetera. And we know that we just talked about at the outset here the fact that the calculus has changed. We're expecting perhaps some short-term interest rate increases to help combat sticky inflation. That's different than what we were hearing at the beginning of the year. So we've had more inflation volatility, as you can see here. This is inverted. So we've actually, this drop in the black line actually represents an increase in that volatility, and then we see the percent of stocks with positive year-over-year 12-month earnings per share move higher. And so you can see how this dovetails, and it has I'll call it positive correlation. But when you see a deviation like that, it's another one of those proverbial divergences that you would expect are going to reconcile over time. That difference is going to reconcile itself one way or the other. Now, we haven't spent a lot of time on the corporate bond market and credit, but I think it's worthy of mention here that we have seen a little bit of pickup in the distress index, particularly in investment grade. That's in the blue line here. We have high yield in the amber, and really no net change there, which is rather odd. Overall market, we've seen a little bit of a pickup this year in market distress, which again usually will translate into higher overall yields to compensate the investor for the increased risk of that distress. But yeah, again, we're seeing just really just initial shoots of this change in leadership, with at least within the credit markets. Something else that I've talked a lot about over the last several years is how you think about a traditionally allocated portfolio, and a lot has been made over the how today's 60% equity, 40% fixed income portfolio does and should look today versus 10, 15, 20 years ago, when it was a lot easier to say, well, I'll put my fixed income in treasuries and I'll put my equities into S&P 500 stocks. And I think you just have to think about things differently, because why you have that allocation is because ideally that you get some diversification benefits, and so you get when equities are weak, bonds are strong, and vice versa, and then that provides those risk-adjusted returns over time that we all want, right? But if you have periods of time where that kind of correlation changes, and here we've got in these little gray areas here that represent the rolling 24-month correlation between stocks and bonds, and right now we're at a point where stocks and bonds are moving in the same direction, so you're not getting that diversification benefit. In fact, you're getting an amplified volatility of potential portfolio returns. And so I show this chart just to say that why we use structured products, which have like downside protection, and it has kind of a different risk profile. And this is we're using these types of instruments to plow through these types of leadership and inflection changes to help drive those more consistent returns over time for the unit of risk that we're taking. This is a chart that we've kind of talked about a little bit in some of the other comments I've made, but it's really the expectation of free cash flow. Again, we know that Google just had negative free cash flow, and that's driven a lot of uncertainty, a lot of speculation, a lot of maybe interim selling pressure, I would say. But you've got expectations here, and this is built into profits as well. And we just saw that in terms of earnings estimates moving kind of parabolic, that over the next several years that the market expects that free cash flow is really going to expand by virtue of all the current spending that's been planned right now. This is the hope, right? And this is the risk, though. If this does not play out, there's going to be a lot of disappointment down the road that I think we will find in turn that we will see manifested in increased volatility. So this, while this looks good, makes everybody feel good, it's a pretty aggressive target. Especially considering free cash flow trends before this big capital spending surge. That there's a lot of bet here that this is going to play out. So we need to watch this very closely. Here we have credit default spreads. Those of you may remember CDSs from the global financial crisis. This is not your father's CDS, but anyway, I would say that these things are all important because it's a measure of risk within these hyperscalers, and you can see all of our favorite ones here, and that those spreads, those credit default spreads, are all increasing because of the skepticism over, is all of this current capital spending going to turn into that free cash flow, those numbers that we just looked at. Again, here's looking at two companies in particular. You've got Oracle and CoreWeave, and you can see how, just looking at those two companies, how those credit default spreads have really blown out here lately. That's all we have for the chart pack. I hope you've enjoyed it. Have a great week, and we'll talk to you again soon. Take care.